Hi everyone. It is October 21, 2022, and in today's title, Snapchat spoils the spy, but the bear market rally remains in play. I think that today what we will be discussing is mostly what would happen next week on the most important earnings season where you've got the big kids on the block such as Apple and Amazon reporting numbers. You've got Microsoft, Google and Meta as well as the major energy stocks setting up for either a strong rally towards new all-time highs or some new 52-week highs. So let's discuss all about this as well as introducing what is happening in your treasury bond yield stocks treasury bonds, which is really affecting the stock market and how the currencies are also acting upon. So for those who are new here, thank you for watching. This is the Awesome 10x Investing channel. We do give weekly free Friday classes, and it's really all about the global markets. And usually we do have Thursday classes talking about the Philippine markets. So it's all for free, and let's dive in for our this U.S. market class for Friday. Okay, I'm gonna share some of our charts here. I will share a couple of slides coming from my previous class on what you have to understand coming into this week's earnings report. Okay, so coming into this week, we have been saying, actually on October 17, and it's now the end of the week, October 21, that we would have so much data to watch out for. You've got the Fed, which actually just did quite what we all expected to do, wherein they will talk hawkish. We have to also be aware that come November, coming out on Fed decision November 2, November 4, you've got the jobs report, and November 8, you've got the midterms. Today is a Friday for the Philippine market, and we did expect that Snapchat could potentially spoil the marketplace. And as of this week, you've had 66 S&P 500 companies reporting and 8 stocks out of the 30 in Dow Jones. In the meantime, we actually had a lot of developing news wherein Liz Truss obviously resigned. We've got today the dollar yen already shooting past 150. Let's just give you some quick roundups of what's happening as the week has gone by. We can see that as traders have been bracing for further intervention in the dollar yen on the strengthening of the dollar, we are so far not seeing any relief rally for the USD, i.e., for the yen to be strengthening so far. It hasn't been happening yet. Let's take a look at the dollar here, the DXY. The DXY continues to rampage here at 113.5. You've got the GBP USD, who actually rallied initially on the back of Liz Truss and Jeremy Hunt actually fixing their fiscal policy. But over time, we're now seeing that fizzle out. As of now, British pound is now trading at 111, so more pain to come. Let's take a look just in the currencies fast mode here. The euro dollar is now trading at 97 cents here. You've got GBP already breaking down yet again. So the setup on your currencies is another wave on the sell-off. And let's take a look as well on your futures. So you've got the S&P 500 futures now. It's looking negative so far. Actually, I'm not sure if this is, wait, for futures, let's just go through the S&P 500 here. So let's go through the indices here. Your NASDAQ futures is down 0.5%, 10,950. Your SPY is now retesting perhaps 3.5 or 3.6 yet again. It's down 0.5%, 3.644. You've got the Hang Seng Index reeling into some almost like how many 10-year lows. Let's take a look at your HSI. It's now trading at 16,200. And if you'll recall, Hang Seng Index is actually down 60%, well, almost down 50% so far. down 51% so far since the 2018 peak here, and is looking to retest another 20 to 30% downward towards 30,000, perhaps on that July 2009 or June 2008 areas, September '08. So Chinese markets reflecting on Hang Seng Index pretty much still on the downside. We've got treasury bonds. Let's just take a look at the TLT here. A lot of people are saying, "Hey, watch the treasury bonds. Your 20-year treasury bonds is falling down, meaning that your yields continue to spike. As the yields continue to spike, they are an inverse format wherein higher rising bond yields equals lower bond prices. And you'll notice that the bonds are actually down from $180 all the way to 94, reflecting actually a weaker bond market, which suggests that the S&P 500 may be too rich, too high valuation. And where the bond markets go, usually the stock market also goes. So there has been a lot of clamor, perhaps from many FinTwit people, macro people, wherever you watch in the headlines, strategists all saying that the S&P 500 still has room to fall 50%. If you're going to look at the averages, at least 35% here, or 3,200, 3,150. Whereas the Uber bears are all talking about a 50% drop somewhere here at about 2,500 areas. So these downsides are not really going to be happily taken by the market. And it is worthwhile to, of course, be attuned with these risks. Saying all these risks, though, let's take a look first on what's happened for this week. So Snapchat already failed. The earnings after closes down more than 25%, pulling the usual suspects, which are your social media names. Taking a look at your big tech, let's just go now towards our portfolio watch lists. Okay, so on the big tech, how did Snapchat actually affect your index futures? Other than that, 0.5% drop already on the SPY, a further downtick on your Tesla, another 1% to 07. Netflix continues to trade quite higher than 250, still trading at 268. Meta is actually down 3.75%, retesting the recent lows of 125. S&P 500 trying to retest 360s. Your QQQ is trying to retest as well that recent low. So let's just take a look at the Qs. Let's go through this on a short-term basis. Today, we're just going to be looking mostly into the charts, as many things in the market are quite impacted on a day-to-day news basis. So far on the QQQs, we have to note that in October 13, with a very, very bad CPI report data, despite fears that we would collapse towards 3,200, what happened was that the QQQs and the S&P, after this 3% gap down, managed to actually reverse into a rally of another 6%. So that was actually a 9% range in a single day, which was actually the fifth largest trading range in the course of history of the SPY. That is actually the kind of ranges that we should be expecting on an epic finale or a capitulation style movement. So I'm not sure, actually. A lot of people, of course, would say that that was not the epic finale that everyone's talking about. That was just a prelude to another epic finale coming out 2023, since the earnings recession is happening perhaps next year. So far, what's keeping the market quite tightly still on the upside and tradable bottoms, as we've been noting this week, is the earnings. So let's take a look on those earnings. But so far, the QQQs, after having a pretty strong bounce and retesting that 250 area, that 260 area, perhaps for tonight, if you're going to be checking out on the movements, as Google and Meta are actually getting sold off with the Snapchat movement, I think this was pretty known by the market that there is a potential sell off on a Friday owing to Snapchat, just like what happened in the last quarter. Take note that Meta is actually opening here at about 126, and how it will move later could be reminiscent to what happened on October 13. where we actually rebounded and actually reversed almost about 7% to the upside. So we would actually argue that should we, like as usual a while ago, we could be gap. So we are gapping down to about 126. If we do see a potential people picking up the 9:30 to 10:30 sell off, that means that there is a tradable rally ahead of the earnings next week. What does that it essentially also is a take a look as well, of course, on all these social media names affected by Snapchat. So you've got Google already trading pre-markets actually here at about 97.98, but 97.98 was actually retested. In fact, 96 here was retested. A lot of chartists have been commenting even before the numbers have been seeing was to actually sell puts on tonight's Friday numbers on Snapchat. So this has always been known already by the market that Snapchat is not really the economic indicator of advertising. And there has been checks that should the market puke based on Snapchat's earnings, which is what's happening yet again now, you should actually not panic and in some ways hold and watch and observe, just like what happened on October 13 and October 14, where we actually got a 3% gap down and yet a 6% rally. So that is highly possible that coming into today, your TQQQs, which seems to be in the pre-markets, already opening at $18, 18.88. We could retest today at about $18 or even below 18. Just take note that what usually happens during these panic sell-offs is actually a gap down where people are buying. So the if there's any takeaway, if this is the first time that you're watching, I think that what we are learning is that bad data, do not react into it. The first thing that you should see is observe, do not react, like first 3 hours or first 2 hours when the market opens later on, even when your bonds are selling off, even when the dollar is already going sky high with the dollar yen already breaking above 150 for the dollar yen. And even in the Philippines, if you are a Filipino who has some pesos, who is actually afraid that it might actually balloon towards 60 above without a convincing intervention from the Bangko Sentral na Pilipinas, I do believe that it is right to be worried, but at the same time, panicking and actually trying to sell when the prices are really bidless is gonna be very, very wrong. In that you should actually be more orderly when you are actually trimming your positions towards cash. So right now with the S&P 500, it's still in the oversold zone. And actually, a lot of earnings we are already seeing, already giving higher than expected earnings expectation. Sorry, actual data, not estimate, was actually being beaten. You actually have some recipes where you have to just choose which stocks or which sectors to be buying into with the sell-offs happening in the market. So tonight you've got actually this Friday, we argue that Verizon is gonna be before the open. Just tonight you've got Verizon, American Express, Schlumberger. Out of these companies that are reporting before the open, we already saw a 9% rally on AT&T, which is why this week we are still long on Verizon. Let's show to you the earnings, right? So this week we mentioned that we were long on AT&T and Verizon. We talked about the possible curveballs on Tesla and Snapchat. And actually, for next week, the curveballs that would make the market potentially fall would likely be either dampening demand or sentiment on October 27 by Apple and Amazon. However, we are not going to be shorting Apple and Amazon, even if we may actually see some guidance on the downside. The rationale is because Apple and Amazon may actually prove to be, in some ways, insulated, not necessarily immune, but insulated from further sell off, with the market, mostly passive index funds, still actually showing some supports towards your Apple and Amazon. Let's just show to you the charts of Apple and Amazon very quickly here. Apple and Amazon, much like these bellwethers and the technology firms, seem to actually be trading still at higher lows. And before we assume the worst, the thing about Apple is that it can actually stubbornly stay above this 129, not unless we get a gap down that may be happening on October 27 after earnings hour. So if ever you are really, really bearish into the market, I think that you have at least 3 days to actually trim positions prior to the sell off, which we aren't even sure about. Because right now, what's been happening is that most of the panic buttons are being bought, and the market is already assuming that while the Fed may talk tough, a lot of central banks around the world are already buying back bonds, which actually was evidence that there is a likelihood that there will be a buyer, and with so many companies actually trading already with massive puts, it is correct to say that enough fear, there could be an epic finale still happening next year, but I don't think that it is right to be aggressively short. So, going through the airlines, let's just go through what happened. Of course, everyone knows that United Airlines had a good number. And let's just take a look at all the charts that already reported this week. Again, we're going to repeat that these earnings were massively being sold off prior. And look at what happened in the aftermath. So, United Airlines, after numbers went from 33 to 39, that is a $6 increase. And this is actually giving you that short covering rally or that earnings related move that we are talking about. United Airlines pushing up. You've got your American Airlines. It was pushed up and then and then sold off, right? Earnings came out. You've got Delta Airlines last week. Those earnings came out. So all of them are, in general, jets or the airlines in general had a nice rally this week, owing to the fact that people continue to actually price in a reopening despite high energy prices and high inflation. So I think what we can learn here, though, is that these June lows have been broken down by many airlines, but it seems as if it is actually trading more into a sideways range where you want to sell near the highs. So if you're gonna sell airlines, it still has a leeway to sell somewhere here at 18, 19, when and not somewhere here at 15, 16. You've got the earnings. So let's just go through again the upcoming earnings that we are gonna be watching out for. Um, so let's start with the energy stocks. Energy stocks are reporting, particularly next week. The biggest numbers are actually happening on a Tuesday and Thursday, October 25 and October 27. Those are things that everyone should be focused upon. That would actually reflect on a Wednesday and a Friday in the Philippine context. So most of the big numbers are coming out Tuesday after market. That means you'll only know it on Wednesday morning, Philippine time. Wednesday, 4 a.m., 5 a.m., depending on, yeah, so about 4 a.m. our time, because we are talking about the Philippines. So Tuesday, 4 p.m. nighttime equals Wednesday, 4 a.m. Philippine time. Let's tell you the setups that are happening. Your crude oil today has been volatile, but what has been very clear from a market sentiment is that the OPEC supply cuts and these shortages, and even the SPR reserves that are being continued this December by the Biden administration, is not enough to actually kill oil to the point of trading $75. What we are seeing here is actually a higher low move, where oil prices actually bounced from 75 and nowadays is trading well above $80, now trading at 84. So even if the world believes in a recession, it seems to me that this worldwide recession, amidst a backdrop of very huge shortage in oil supply, means that we would trade with elevated inflation levels, much like what's happened in the past. So let's just take a look in the past. We've had 2013, 2011, 2015. This was about 4 to 5 years of price levels of oil trading at 84 to 110. So while we are not really expecting that the oil will continue to go above $100, although it's actually all a question mark after the SPR reserves are finished, it should be noted that oil is structurally in a positive trend. So there is a structural supply shock. That means that with oil prices structurally in a shortage, if even if oil were to trade at 85 or 90 or 95, many are of the opinion that oil stocks, which are trading at all-time lows, well, not at all-time lows when it comes to stock price, but historical lows when it comes to their valuation, owing their high profits for the last 20 years already. Let's go back to our take note that we've discussed all of these oil-related themes. Let me just get you some title pages here. Crude oil renaissance, global economic recovery, oil $90 becomes floor. We talked about Valero last time, but just to tell, just a quick peek to just give you ideas. ExxonMobil Chevron is reporting this week. You've got Hess, you've got Hess Corporation, you've got, of course, tonight you've got Schlumberger. Let's just go through the fact that U.S. has caught up with Saudi Arabia and Russia, but still is not enough. Your Permian Basin is not enough when it comes to supplying energy. And when it comes to cash flows, of course, these are the only ones that have a tremendous earnings until next year. So knowing that, let's just go through all these big companies' earnings, which are going to be released next week. Already, the market has been heavily loading up. You can see that from a charting standpoint, ExxonMobil, no matter how volatile this 2022 year has been, it has always been met with more buyers each earnings season. So on February earnings season, there was a consolidation and eventually went up a month after. On May earnings season, there was another entry point at 82 and proceeded to go near $106. Around June, when oil prices actually collapsed from $120 to $80, owing to the artificial SPR being released by the USA, a million barrels of oil per day to contain inflation. We saw that it consolidated and here at about $93, even before the SPR reserves are ending, which was actually forwarded until December. We already see that with the OPEC supply cuts, the market has priced in this breakout move from 93 to 105. So that was a 12% outperformance in the stock price of ExxonMobil, even when the S&P 500 is obviously languishing, perhaps the new lows or trying to bottom out. Now, would it be possible that the ExxonMobil and Chevron could cushion the S&P 500 from falling to 3.2? And the answer is highly possible should ExxonMobil take the place of your big tech. So right now, we have been opining for quite a while that the S&P 500 is a function, of course, of companies in the banking space, of technology, of oil and gas, whereas maybe in other countries, they may not be an oil and gas producer. And this may be one of the reasons why the S&P 500 earnings is insulated simply because you may not be aware that the largest oil and gas producer also is in the US. So it makes sense that ExxonMobil, which is now great generating larger profits than Alphabet, i.e. Google, would actually trade at a higher valuation than Google. So there is a case to make that ExxonMobil can actually trade from $100 today towards 110 or 120 and can even go as high as 150 to 200 within the next 2 to 3 years. And if you see ExxonMobil actually trade that high, of course, that would mean that all the passive funds will either have to sell their Tesla, sell their Apple to buy more ExxonMobil into their portfolios, making your S&P 500 sustainable at about 36 or 3650, even when your Tesla is collapsing to new lows, even if your Apple could go down towards 130, and so on. You have to understand the S&P 500 is 500 companies. Just because the S&P 500 has not fallen to 3.3 or 3.1 or 3.2 does not mean that some components are not going to fall off. Of course, we've seen how Netflix was able to be from 700 going down to 160 and then rallying towards 270. That's because the S&P 500 does not compose simply of Netflix. So the S&P 500 obviously is not just simply banks, and the banks seem to show to us a leadership in the sense that they can offer dividends, and the valuations of the banks such as JP Morgan and the Bank of America is trading at less than 6 to 7 times multiple. So I think that we are in a scenario, guys, where financials and energy can overtake in some cases on the allocation weight of a Tesla, and it can actually overtake some positions in your top 20 stocks in the S&P 500. So ExxonMobil, let's take a look again at the charts, guys. Also, there is, of course, a comment here. Wouldn't China reopen from the zero COVID? And would oil price suddenly jump if they reopen? And the answer is yes. We do believe that oil prices are artificially being slowed down at about $84, $85, whereas it could really take $100 should China reopen. But the only reason why China may not actually take oil prices beyond 110 is due to demand destruction itself that is impacting the manufacturing PMI, or producer manufacturing index already of China. So even if China reopens, I do believe that people think that oil could stay 85, $90. And from a earnings re-rating, a multiple re-rating can happen because, as we should note, again, let's just note that ExxonMobil is trading at 10 times multiple and is actually earning bigger than a Google. And Google today actually trades at about 20 times multiple, with headwinds on the digital advertising landscape, which is also happening towards your Meta. So what you can see here is that ExxonMobil over the last 10 years in 2011 to 2012 had been stopped here at $104. And just simply from your charting per se, you are seeing that these all-time high moves of ExxonMobil can actually take it just simply from a chart towards 120 to $140 come next year, owing to a simple thing: multiple re-rating. Multiple re-rating due to more predictable cash flows, because if they can sell oil worldwide despite $90, which it seems is a story more of supply, a supply shock, then we can really assume that this market is in the 1970s arena, where you've got the high rates, high interest rates, very high inflation, which is gonna mean a worldwide recession. So the recession is really something that will impact the sector. In particular, your Tesla is actually at risk. Speaking of Tesla, this week, of course, we saw Tesla hit new lows. So everyone who actually assumed that there could be a support on Tesla at 200 is now faced with the reality that it might actually break. So, for instance, if ExxonMobil perhaps hits 120, a scenario that can happen next year or this year, year end, we'll see about that. The breakdown of Tesla should open up now towards a level of 175, or around another 10 to 15% sell off. So be careful for those who are holding their Tesla shares. Earnings last quarter is not as well as expected. They don't believe that they can grow more than 50% in terms of deliveries. And just like any company is not immune to any sell off, the first chart movement of Tesla is probably at 166. And then you may actually be surprised just in case Tesla has a negative sell off further towards 120 or 180 next year. I really am not quite sure if Tesla will hit 40 to 50% lower next year, but I wouldn't want to hold Tesla in a worldwide recession just for safety. So safety wise, I would rather hold cash. Okay, but that doesn't mean, of course, that we should have our entire portfolio in cash when you've got the upcoming earnings season. The upcoming earnings season is giving a chance for everyone to actually continue longs on energy names. Let's just take a look at your S&P 500 XLE. This contains your largest weights towards your energy sector. And true enough, you're seeing that the biggest news perhaps for chartists is that we seem to be breaking out in this earnings standpoint just as the S&P 500 is on the verge of a breakdown. So the XLE may actually end up being the only barometer to keep the S&P elevated. Remember that it used to be the technology stocks that held the S&P. In particular, it was Apple and Tesla that was trying to save the world by simply staying stubbornly high. Nowadays, I think that it's gonna be Tesla falling down, and it's gonna be perhaps, I don't know what's gonna happen to Apple next week on the earnings, but that is a concern to also be aware of. Since Apple already warned about the iPhone shipments, and they have been currently trying to introduce people towards the high yield savings account towards Apple Pay, given that Apple has more than $200 billion in cash in their balance sheet, which of course can give Apple Pay savers 1 billion accounts so far, at least a 2% savings account, just like the banks are. So I think like Apple might be more insulated than a Tesla because it has several software revenues that have been recurring. It's not as overvalued, although I wouldn't say that Apple is immune. So there are several volatile indicators that if PC shipments are down, if semiconductors are warning of a very, very gloomy future next year, AMD warned about it, a 30% reduction in revenues. Of course, the market sold off ahead of the earnings already about that. We will just have to see on whether is it priced in, given that interest rates at 4.75% is not really going to derail the Apple revenues and earnings. It's just a multiple earnings contraction that we may actually be talking about when it comes to Apple. So again, as I said, where will the money want to be safe upon? Seems like it's energy stocks. So energy names here are our safe haven place. We talked about, if you recall, we talked about the dividend inflation names that you have to be checking upon. And our picks there were Valero. So far, Valero, if you can check it out yet again. For those who are new here, go to Awesome 10X. We talked about the dividend names around September 16. We also talked about Vermilion Energy. So around September, we've been trying to discuss that the market will try its very best to hide into utilities, oil and energy, staples, dividends, not necessarily in technology. And if you are looking in the S&P 500 or the Qs, you should be aware that it is simply a bear market rally, and it is not a sustainable rally to think about. For all we know, the Nasdaq will drop 10 to 20%, not just this year, but perhaps next year. And I'm talking about an additional further downside. It's an additional further downside in case Apple, Amazon actually breaks to the downside. So let's talk about those risks before the numbers next week. Large risks on Apple. Currently, Apple has been unable to break above 156. And what we are trying to do on Apple is actually to buy a put option here at 155. And although there is a certain support so far, short term at 130, just in case 130 breaks down on a negative print on Apple, just in case, as we don't know the future, you may actually still have support here at 120 area or 125. So then again, of course, from 143 to 125, that is a massive 10 to 15% drop. So in case you want to actually be safe into your Apple heading into earnings, you may want to actually be either owning some hedging through puts. 155 puts may work for an Apple if ever you need to protect. Now, of course, you can also see that next week's numbers is Amazon. Okay, same thing. Apple and Amazon, both higher lows so far have not broken June, but that does not mean that it will not break June come this Thursday, Friday season. So just in case we do see a breakdown, a 20% sell-off on Amazon will already catalyze that 3.5 area for your S&P 500, 120 hitting 90 for a support. Those are scenarios to watch out for, not necessarily going to happen. Of course, if Apple and Amazon breaks down, you should be sure that Tesla would have broken down, breaking the 200 down towards 166. So, should you short a Tesla after the earnings report? I think that right now, given that the earnings didn't do well for Tesla, what might be a safer way is to actually short the Tesla rather than shorting Apple and Amazon, because you don't know yet what the numbers of Apple and Amazon are versus Tesla, which already reported, and you can already see that Tesla has selling pressure now, even as 210 and 219. So if you're selling Tesla 207, then that may actually prove to be a safer case rather than shorting something that has not reported numbers yet, just to prevent any surprises. And even if Tesla actually manages to crawl up, we know that it won't be able to sustain given there's a lot of breakdown pressure here at 228. So if you don't like to short Tesla, we can argue that you can, of course, get the Tesla inverse bear. The Tesla inverse bear, so we were seeing that Tesla was actually already being pressured at $300 and $280. We said that you could buy Tesla TSLQ at about 40. And nowadays, it seems that there is a higher low already in TSLQ at 46. So again, I'm saying that if you want to hedge yourself for a potential sell-off, simply reverse a Tesla long to a Tesla short. Simply go long TSLQ. I hope that is clear. We want to be clear that next week it's very volatile. Volatility means that you want to be hedging yourself on companies that have proven weakness, not something that is an estimate, but a proven weakness already. And that has been shown on a Tesla. Now, I know that you may want to short ahead of numbers, but it is very difficult to short before the result. So I personally would rather be on the selling zone if you already have proof that Apple and Amazon will break down. Now, so I think that the TQQQs, it's still a question mark. Some people are probably assuming that TQQQ would fall all the way down, and that SQQQ or the Nasdaq is gonna break towards all time lows, such that the inverse is already gonna go up. I actually do not know what is the short term reality for your Nasdaq, because Microsoft and Google, in my view, is actually insulated, and you've got the earnings of energy and the earnings of Colgate Palmolive, Coca-Cola, McDonald's, who actually may reflect something similar to what the banks have said, wherein the consumers continue to spend. And if you are very early in your shorting, you might actually get squeezed. I would like to echo actually this line from yeah, so I was reading. It says here that a short squeeze at the wrong time will do the trick. The market has the uncanny ability to screw people on the way up and on the way down. So even if the entire market may be correct that we will go down towards the end of the year or next year towards new lows for the S&P 500, it should be noted that come earnings week, extreme volatility is expected to continue, and it will wreak havoc with your investment strategy if you are so confident with one side action. Well, that means that I'm saying that although I am biased to the upside for your energy stocks, and I'm quite neutral towards your FANGs, neutral in the sense that I don't think you are safe whether you're going to be long or short Amazon, Apple. And if you're going to be shorting Tesla, it's only because we can clearly see where your stops are going to be. If you're going to short a Tesla at about 209, you have a stop loss somewhere about 225. So that is quite a defined risk in case you get into your shorts. At the same time, if you're going to have an Apple put at 155, I would assume that if Apple suddenly breaks above 155, obviously you will also close that short. So I would say that protecting yourself with a defined risk is more important rather than completely saying that this is what's going to happen with the TQQQs, this is what's going to happen with the SQQQs, this is what's going to happen with the dollar yen. It's very important with the earnings season that we do not predict and, in fact, react more knowing what has been the results. So, I think there are also questions on whether Snapchat should be shorted after the numbers. And the answer is unfortunately, although Snapchat is down 25%, you'll notice that it is always futile to be shorting when it is already oversold, even if it can continue falling further. What I think what's happening is that whether you're looking in Snapchat that is hitting new lows and Twitter hitting 9% down, you will actually see that social media names are very volatile. And instead of actually reacting onto that, like everyone else who was already predicting Snapchat's gonna completely shit the bed in your index, it should actually be perhaps a reason to take a look later on whether Apple, Amazon, Meta, and Google is actually gonna be bought. And if a drop later happens, perhaps it is actually an entry point, in fact, towards the energy, which is reporting next week. Speaking of energy, let's just go through again some of the most important things. We talked about this data. Let me just repeat it yet again. This slide comes from 9 Point Partners, where they try to tabulate a lot of your energy, oil, and gas companies with an assumption of a $90 WTI and quite a valuation for the year end 2023. And they've found that in their analysis, your Vermilion Energy happens to have a 40% free cash flow and yet trades at about 1.5 times enterprise value. So it actually is one of the cheapest. And then further out, you are seeing Ovivi, which is Ovintiv. You've got Crescent Point Energy, and then Crescent Point Group, Energy Group. You've got SM Energy here. And they've noticed that your more expensive ones are Devon, Fang, ConocoPhillips, EOG, PXD. You've got MRO, MTDR. So basically, they're also seeing that on the average, almost all the companies in the energies group is actually generating above 23% free cash flow yields and is sporting around 2.5 to 3x in terms of enterprise value. So from just a fundamental valuation per se, what they're saying is that Vermilion Energy presents alpha, guys. It means that it is alpha. So from a US perspective, Vermilion Energy here, you can notice that we are loading up ahead of earnings next week. The earnings is November 9 for Vermilion Energy, although we have seen in the past that the company would go up even before the earnings because the Chevron and ExxonMobil are already going to share their report ahead of the smaller companies. So if you recall, let's take a look at Vermilion here around the August before the earnings here, which was it was trading $22 here. After the earnings, it rallied 36%. But even before the earnings of Vermilion, around June, July, when the market was trying to bottom out, it was already rallying 36, giving you a 36% move and then a correction and another 36 move. So we think that possibly Vermilion, ahead of the earnings on November, can actually rally from 20, a 36% move as well, perhaps as rallying as 28, selling off at about 24. That would be a retest of this resistance. And then after it hits 24, another 36 move. So that gives us a 70% potential move towards 34 if we get in at 20. So, guys, what am I saying here? Let me repeat again. We have a potential view that Tesla is a sell. ExxonMobil might hit new highs. And if ExxonMobil hits new highs, it means that the smaller companies who are cheaper and also have the same characteristic of high cash flows can give a higher return. And one in particular company that we have discussed is Vermilion Energy. For those who want to really have a deeper dive on what Vermilion Energy does, just a quick look. Vermilion Energy is an international oil and gas producer based in Calgary, Canada, operations in North America, Europe, and Australia, and it is dual listed in Toronto and New York Stock Exchange. I think that if you take a look in their assets, which they shared, of course, in their company website, the three core areas, North America, Europe, and Australia, are really benefiting today on the Europe winter, where European natural gas prices are 2.5 times greater than North American gas prices, where European assets contributes 35% of the total corporate production. Now, you might actually say how miserable it is for stock investors to make money off of European misery, but the financials are the financials. What this simply means is that Europeans who are suffering today, paying 250% higher natural gas prices, are making a few companies like Vermilion tremendous amount of money. And with Vermilion Energy making a ton of money, what are they doing? Quickly, let's just take a look for Vermilion. The PE ratio is already expected to go from 5 times multiple to 3 times multiple. You've got a company with a market cap of a $5 billion company, and the book per share is $16. The dividends can potentially increase if they so wish, and they have already announced that since August. So Vermilion already announced an increase of quarterly dividends, and they may continue to increase this, planning to return 25% up to 75% through share buybacks and a regular and special dividend payment. They're also promising to buy back 1.5 million shares every day for the second half of this year. I repeat, guys, let's repeat that for those who are new here. VET Vermilion announced the plan to buy 1.5 million shares every day for the second half of 2022. So, with the European exposure and natural gas still staying at $6, it is very, very hard for Vermilion to actually report a bad income when it is already trading at just 3 times PE ratio. So again, for people who do not have any idea, I have cash and I wanted to earn money. Should it be parked somewhere? Perhaps Vermilion Energy at 22.05, even if it falls to $20 because the S&P 500 is haywire, is giving us, guys, an alpha move. Even if Snapchat goes down to spoil the spy, I think that everyone should know that a decade of zero returns is not necessarily a decade of zero returns for you and me. We simply have to be more careful of which companies that we should buy. And we've identified that insanely high free cash flow yield with a scope to provide perhaps a 10% dividend yield. They could probably pay $2 at $22, $20, reaching a deleveraging target by early 2023. You just need to see 1 year and you will get that dividend move. So you already have also that 8 cents already given, and they'll be giving more. So Vermilion is one company for us to really make a bet upon. Furthermore, of course, we already discussed, if you recall, again, I've discussed a company called Apache and Valero, right? So Equinor, we talked about this. We're just reiterating that the thesis is not wrong and it continues to be reiterate by, especially since this December, as we all know, the strategic petroleum reserves are already gone. That means that there will be nothing to prevent oils from spiking 93, 95, $100, which actually spells nothing but ballooning profits towards these companies: ExxonMobil, Chevron, British Petroleum, ConocoPhillips, Total, and Shell. Let's go through the charts yet again. Uptrend for some, uptrend for CVX. Let's do this on a weekly format. These are all uptrends, right? Your Chevron is now trading at all-time highs here. How about your Total Energies? Total Energy. Total Energies is trading in here, Germany. You'll notice that they all trade near highs or near all-time highs. You've got Shell. Royal Dutch Shell is trading in the US, also trading at an upper end move. It is lower than the rest, but it seems to have been reversing, obviously, also on the upside. From a daily or a weekly, people may actually want to get in because Royal Dutch Shell is actually trading at the support area here at $52. We also, of course, believe that the Shell Philippines, which is a subsidiary, which is trading in the Philippine Stock Exchange, also seems to trade at a very low valuation compared to the earnings that it actually has been getting in. So there was actually a short-term resistance breaking down here at 20 and 19 for Philippine Shell, but it seems that there's another buying pressure here at 16.18. So we resume buying Filipina Shell actually here from 16 to 18, knowing that it still presents massive upside, perhaps 30 to 45, if we simply judge from historical valuation of what oil companies should really trade at. So there is real alpha in energy earnings season. Again, let's talk about those companies here. So Shell, Chevron, BP, British Petroleum, and ConocoPhillips. ConocoPhillips here is trading at near all-time highs. You can clearly see that from the chart. COP, $120. We're seeing, what did I mention? British Petroleum, BP is trading in both London Stock Exchange and the New York. So the only reason why British Petroleum is not trading yet at all-time highs is because the currency devaluation of British Petroleum, wherein it receives sales revenues in GBP, is getting affected as well. So actually in the Philippines, if you ever wonder, is it possible that the Shell Philippines is also going to be impacted by the dollar peso depreciation? And the answer is yes, because their costs would stay in the dollar and their revenues are in Philippine pesos, or in British Petroleum's case, their revenues are in GBP. So when they sell to Europe, they earn Europe or they earn British Petroleum. So there's really that depreciation risk as well. But I don't think that the currency depreciation is enough to really be afraid of their earnings movement for this year and also for next, of course, for next 2 to 3 years. Okay, so again, we talked about how important the dividends will be in a season of high interest rates. So our dividend ideas for a potential buy and keep for next year is Valero, Equinor, and Apache. We also said that we do consider ExxonMobil will still be bought. We do believe that typical funds would buy Chevron and ExxonMobil. However, we believe that Valero has more upside. We also think fundamentally Equinor is more undervalued, and giving at least a 3% dividend yield, and from a target price per se, at least 50 to 100% price appreciation due to the large cash flows, where you are seeing a trading pressure of just 2 to 3 times price to cash flows. So Norway is very rich. We want to remain very bullish on Equinor. It is a dividend payer, a dividend aristocrat. Same for Valero and Apache. For those who want to buy and keep, perhaps 3 years, 10 years, I do believe that in a case of high volatility, that the market may actually be buying and selling these names, but they would always try to buy this on a dip. So if there is a buy the dip story in the market, it is the energy as a buy the dip story. You could see that every dip of Valero has been bought. It was bought here at about $99, another buy area here at $100, another buy here at 110, and so far 124. So if there's a buy the dip trend in the energy market, there is no reason for you to stay in cash. What it means is that you can actually try to buy and sell and buy the dips and sell the rips for the energy market. You can just choose Valero, you can choose VET, you can choose Apache, right? APA Corporation. You can, of course, choose the earnings coming out this week, which is coming out for Hess, which seems to be poised towards all-time highs. You can choose to actually take a look later on Schlumberger. Schlumberger is already reporting numbers, and what you have seen here is that it went from 34 to 45, or a 35% outperformance even before the earnings comes out. So, what I am showing to you guys is that you don't want to wait for every energy stock ballooning to all-time highs before you predict that, of course, it's going to go higher. Yes, you may say that it's already been going up for the last 100, 200 days, but I would disagree because there's actually a consolidation. Let's take a look yet again. Vet, you could have bought on March. It was trading at 22. Today, it's November. It is already 8 months after you are still able to buy it at 22. If you think that it is quite weird why Vet is 22, my answer here is that it is highly possible that the company is still buying back the shares and it is trying to prevent VET to go high to the moon. The market is, of course, anticipating that Vet will eventually go 40, 50% higher, and it is your time to actually get in. Let me just answer because in the comments there's a question, how about NEO? Unfortunately, guys, there is no love for electric vehicles. In fact, we gave a short idea even just recently for NEO at $20, and NEO is now trading, I think, new all-time lows at 10. And I don't think that there is demand for electric vehicles. And with waning demand sales, you can actually see NEO probably trading from 11 towards 6, and it will continually to be shorted, much like why Tesla will also be shorted. Electric vehicles would be a short. It is actually, although I wouldn't probably sell a NEO, I think that I would short Tesla more simply because there's more leeway perhaps for Tesla to fall rather than a NEO after the earnings came out. Okay. All right. So I think that I just need to share just a few things. Old economy names would also be very much loved into this market. So next week, this is gonna be washed out upon. This week, we already saw how Procter and Gamble was bought and then sold off. However, I think that for Procter and Gamble, just check on whether there is a support area here at about $120, 122 area. We're already seeing that staples are still being shunned away by the market. Colgate Palmolive is trading at about $70 ahead of earnings next week. I'm a bit of a contrarian there. Verizon is reporting tonight. I am a buyer there. AT&T was bought in the market, so we've bought it before earnings. We were proven correct. Next week, you've got McDonald's, Chipotle. In terms of selling off on restaurant spending, this Chipotle, I am actually preparing to short if it actually moves up ahead of earnings. So I think that we are in a mixed sell-off, mixed earnings season here, where companies that are very expensive and will have a risk of a slowdown will be sold off. So yon, I don't want to take all of your time, but I think that I've given quite enough data wherein we are really seeing that the best place for your money to be parked upon is to actually get in on some small cap energy names. So I mean, it's quite evident. All of the charts are actually on the upside. This is your SM Energy Company, your Matador, showing to you how the movements are. Devon, which is quite expensive, but it's also still trading actually at a higher low pressure with a potential breakout here. You can see that movement for Devon. So it's you've got FANG, FANG, Diamond Back Energy, quite expensive versus the rest in the oil market, but is still on the upside. So I will not disagree with what the charts are saying. And if there's anything that we want our money to be, it is to protect it as much as possible. And if the protection is in cash and energy, we have to do what is necessary. The S&P 500 will be volatile. I wouldn't actually want to know if it's going to fall or if it's going to rise. What I am clear about is that 3.9 for the SPY is a sell. So far, 3.5 has been a buyer, 3.6 has so far been bought. So it is looking like a trading range for your index so far. Things can change, obviously, but we just pay attention to how these supports will matter. We will watch out on what happens on your Apple at 130 if that breaks down, or your 155 where we want to sell your Apple. Okay, thank you very much and see you again next week as we try to dive in at next week. Your numbers are already reported, so we'll know next week what happens on your Apple and Amazon. So thank you and see you again next week. Bye.